How would you like to get into the hot topic of the day in real estate? Hello and welcome to Fun Financial Insights, the channel where we make the complexities of financial entertaining and easy to understand. Hold on to your hats because today is about to be a ride where we break down what is going on with the 2024 housing crash. So buckle up as I'm taking you through some roller coaster loops through why some analysis are blowing their whistles, signaling that the looming housing crisis may make the famous 2008 crash appear like child's play. It's no longer speculative, but a horrifying reality that is at our doorstep. Therefore, grab your popcorn and get ready as we peel back the cover of this transformative event that will shake the very bedrock of the real estate industry. So let's start by delving into the concerning trend of surging mortgage rates in the past few days. The mortgage rates have gone up, especially for the average 30-year mortgage rate, which is at 7.6%. Just to put this into perspective, it is important to note that this is the highest level since December 2000. Now, you may be thinking, wait a minute, why does this matter? And what does it mean for housing in general? The first impact of increasing mortgage rates directly affects buyers' purchasing power on affordable homes. As interest rates rise, so do borrowing costs increase, making it more difficult for people or families to access the market for houses. Consequently, demand for housing can decrease since fewer people can afford it at a higher interest rate. Also, with adjustable rate mortgages held by many homeowners or those considering refinancing their loans, there will be financial strain due to heightened mortgage rates. This can also have a domino effect on the economy as a whole. As families set aside more and more for housing, consumer expenditures may be reduced, leading to an economic lag. In addition, there may be slumps in industries such as construction that closely depend on the property market value, given declining interest for such products due to increased charges of borrowing. Now let's take a look at inflation factors. Now, first off, what is inflation? When it comes to analyzing the dynamics of the housing market, it is important to understand how inflation influences home prices. Let's discuss inflation and real estate. Inflation, in simple terms, refers to a situation where goods and services are generally increasing in price over time, causing a decrease in purchasing power. Housing market-wise, inflation also determines the worth of houses significantly. As everyday commodities rise in value, materials for building homes becomes expensive too. The cost of constructing new houses rises alongside that of land associated with them. Inflation is a key factor of the worth of homes in housing markets. When ordinary commodities and services become more expensive, construction inputs such as building materials, labor, and land similarly go up. This will increase prices for houses due to added costs. Nevertheless, it is important to account for inflation when assessing home price changes over time. Why? If not done, one may arrive at misleading conclusions about property value appreciation or depreciation. For example, if we only use nominal home prices, which are current dollars based, the extent of home prices appreciation could be exaggerated. To give a better understanding of trends in house prices, economists and analysts often resort to inflation-adjusted indexes. One such index is the CaseShiller Inflation Adjusted Index, which measures how much homes have changed in price after taking into account inflationary effects. Thus, adjusting the inflation makes this index useful in determining the real gains or losses of house values over time. It is important to adjust for inflation when assessing property values because inflation significantly affects home prices. The relevant adjusted Case-Shiller index is a useful tool for understanding what is happening in real estate markets and making decisions based on facts. Now, you may feel disconnected from some of these changes in numbers, but don't worry, at the end of this episode, I will show you how all these affect you as a homeowner, a potential homeowner, or as an investor. But if you're enjoying this video and finding it helpful, please take a moment and hit the like button and subscribe to our channel. And don't forget to turn on the notification bell so you never miss an episode. The current housing bubble must be compared to 2008 crisis to understand its seriousness fully. These historical parallels can help identify some of the alarming trends as well as deviations from historical norms that we have experienced in recent years. This will help us to understand how the characteristics of the current housing bubble are similar to those of 2008 crisis. Both cases have seen a rapid increase in home prices, often fueled by loss lending practices, speculation, and artificially low interest rates. This unchecked growth in home prices has created an environment ripe for a bubble, where prices have become detached from fundamental economic factors such as income, growth, and affordability. This similarly also extends beyond a rapid appreciation of home value. Also being mirrored here are risky financial products responsible for the crash of 2008, like subprime mortgages and complex mortgage-based securities. These unsafe lending behaviors have once again found their way into the real estate market, thereby raising concerns about the stability of our financial system. But it's not only similarities that are of concern. There are also been some deviations from historical norms following the 2008 crisis. This has seen the housing market move even further away from normal by historical measures since about 2012. Despite being taught a lesson in the 2008 crisis, we are witnessing a return to speculative behavior and risky lending practices that caused its collapse before. Central banks, especially the Federal Reserve, have played an increasingly prominent role in determining the direction of the housing market policies. The Fed has unwittingly helped inflate the housing bubble through low interest rates aimed at stimulating economic growth and thus making artificially low rates normal. To comprehend the present dynamics, it is essential to understand how much interest rates can influence housing market trends. Let's consider how the Federal Reserve, which is the central bank of the United States, influences interest rates. By utilizing monetary policy tools such as open market operations and adjustments in their federal fund rate, they can manage short-term interest rates effectively. These measures have often been taken by the Fed during periods of economic downturns or recessions where interest rates have been reduced to boost economic growth. When faced with a financial crisis in 2008, the Federal Reserve undertook an unusual path in terms of monetary stimulus by pushing the interests lower to nearly 0% and also buying large amounts of assets in what came to be known as quantitative easing. This was necessary for reducing costs associated with borrowing, encouraging investment, and prompting the recovery of the economy. Conversely, although these efforts managed to salvage most of the economy from total collapse, especially after cutting down its key mortgage rate, still some unexpected consequences affected the housing sector. Lowering interest rates dramatically led to inadvertent encouragement on borrowers' side because interest rates have never been so low before. With mortgage rates at abysmal depths, homebuyers felt encouraged to take out bigger mortgages, which increased demand for houses and raised prices. Now, let us look at the implications of such artificially low interest rates on the stability of the housing market. Low interest rates are known to fuel economic growth in the short term. Nevertheless, they have some risks, like overheating asset markets that can lead to financial instability. Within this context of a housing market, a protracted period of low interest rates may allow unsustainable price appreciation as home buyers strain their budgets to afford more and more expensive dwellings. And now, like I promised, how does this affect you as a homeowner or someone who wants to own a home eventually, or even as an investor? Rising mortgage rates could mean that as a homeowner with adjustable rate mortgages, ARMs, you will face even higher monthly payments if you decide to refinance your home loans. As interest rates on mortgages increase, if you have variable rate loans, you will have to pay more for your house each month. Foreclosures happen when homeowners fail to pay their mortgages and lose ownership of their homes. The increased rate of foreclosures leads to an oversupply of foreclosed properties that puts downward pressure on housing prices. Consequently, property values decline even more, further worsening homeowners' financial crises, causing more foreclosures and distressed sales. As an investor, if you were engaged in real estate investment, particularly on the assumption that prices would keep going up, you could find yourself in a dangerous position when property values fall. Investors may face the challenges of negative equity, a situation in which the outstanding mortgage balance is higher than the current market value of the house. Doing so may lead to reduced liquidity and possible financial stress as due to being an investor. There is a high chance you are unwilling to sell your properties at a loss. If you're trying to make money by investing, or if you want to buy a home, you must think about this thoroughly before you decide. Remember, you need to do your own research and due diligence before you proceed with any financial decisions or investments. With a firm understanding of the market and the influencing factors as I shared in this video, you will be able to make the best decisions in preparing for any event of a crash. Thank you all for watching today's video, and if you have a question or something you like about this video, please leave a comment in the comment section below. And don't forget to like, subscribe, and share this video with a friend. And until next time, stay informed and always strive for a brighter financial future.